This is Nightly Business Report with Sue Herrera and Bill Griffin.
Crude climbs. Oil prices rise to their highest level in years as tensions escalate in the Middle East. Running hot, Federal Reserve officials see the economy strengthening, and that could mean hiking interest rates even faster. Last-minute tax tips. In a rush to meet the deadline, you don't want to overlook some money-saving moves. Those stories and more tonight on Nightly Business Report for Wednesday, April 11th. Good evening, everyone, and welcome. I'm Sue Herrera. Bill Griffith is off tonight. We begin with oil. The price of domestic crude climbing to a 3-year high as tensions rise in the Middle East, feeding concerns over potential supply disruptions in the region. Midday, there were reports that Saudi Arabia intercepted rebel missiles over Riyadh. One missile reportedly targeted the Saudi Defense Ministry. The other was headed to Narjan, home of a Saudi Aramco oil facility. So oil prices were also lifted by the potential for U.S. airstrikes on Syria after the president criticized Moscow for standing by the Syrian president. On Twitter, President Trump wrote, quote, "Get ready, Russia, because they will be coming, nice and new and smart," referring to missiles. The White House says airstrikes are one option. Crude rose 2% to settle above $66 a barrel, while the broader market came under some pressure. The Dow Jones Industrial Average fell 218 points to 24,189. The Nasdaq was off 25, and the S&P 500 declined by 14. So what will those rising oil prices and rising tensions in the Middle East mean for the stock market? Joining us to discuss that are John Kilduff. He is the founding partner at Again Capital, and Jeff Kleintop, Chief Global Market Strategist at Charles Schwab. Gentlemen, welcome to both of you. John, I'm going to start with you because there is late word from the UK that the Prime Minister there may call an emergency cabinet meeting and that she has moved some submarines into position in case there is an airstrike. What is that going to do to oil?
The winds of war, Sue, are clearly blowing here, and you saw the price rise today on the president's tweet, on those missiles that were fired, as you mentioned, by Iran-backed Houthi rebels in Yemen. Just lining up the players here, you can see that the whole region is in play. The crux or the epicenter is Syria, and this time it's going down big. The French are also in the process of being involved in this. It's going to happen. It's a matter of when, if not if. What I'm hearing is it could come as early as tomorrow.
So, Jeff, if there are two schools of thought on this. One is that if that type of military action did take place, that the stock market would move smartly to the downside. The other is that the U.S. is a safe haven play when there is turmoil in other parts of the world. How do you see it playing out?
You know, Sue, unfortunately, we have many, many years of history to look at when we look at coalition and U.S. missile strikes. And while the human toll is immeasurable, historically, the market reaction is very brief. Whether it's U.S. or overseas stock markets, they all tend to pull back that day of the strike, but within 5 days, more often than not, have usually recovered those losses. What tends to go up are oil and gold. We saw that reaction, of course, in the markets today, but I think the stock market reaction may be brief and short-lived.
So if you're a longer-term investor and we do see some sort of military action and we do see oil prices move, from what I'm hearing from you is you shouldn't change your overall game plan.
Yeah, unfortunately, these types of events are an ever-present part of investing. It's why we diversify and why it is so important to have a diversified portfolio to buffer the type of shorter-term volatility that often comes along with these types of events.
Mm-hmm. So, John, if indeed the scenario plays out as many people are forecasting it to, how much more upside is there to oil, do you think?
Potentially quite a bit. Here's my worry, and Jeff's one of the best on the street. It's a privilege to be on with him tonight. I just have to caution that the earlier instances of this we've had mostly involved attacks on Saddam Hussein's Iraq alone, with overwhelming force really both times. And those were episodic. He just had no defenses. He lied about having anything in his power to fight back with. This is different. You have a very determined Russia, an Iran that has a point to prove and on the rise. You also have Saudi Arabia and Israel teaming up who want to go after Iran, especially in Syria. there's a potential this one doesn't come and go with a few bombs and missile strikes within Syria. It could last, there could be retaliation. Oil goes easily over 70, 80, 85. It depends how the narrative plays out. I can't be as sure this time that it's going to be a pinprick type of operation.
It feels different to you than others?
Because there's just too many other players involved, too many substantial players on both sides of the issue, if you will.
So, Jeff, if we see that type of a scenario play out, would you, if you're a longer-term investor, try and hedge your portfolio a little bit by maybe moving into some commodity plays or not?
That may be one of the more effective ways to think about hedging some of the risk here, if indeed this is a very different type of event and we see global supply chains disrupted for extended periods of time. Anything economically sensitive to production may be hit, but there are areas, gold, for example, other commodities that may benefit from this type of thing. So if you don't have any exposure to those types of assets in your portfolio, again, diversification is probably your best bet here.
And John, very quickly, I've got under 30 seconds. This also comes as rising demand for gasoline. We're going into the driving season. Commodity prices overall go higher for consumers on this?
There's definitely a geopolitical risk premium in energy prices right now. The demand story can't be ignored, though. Here in the U.S., our refiners have been cranking out record amounts of gasoline and other products, exporting a bounty of it as well, particularly of gasoline. We're a big supplier to Mexico all of a sudden because they've been having problems. So, yes, there is underlying support overall for energy prices. The situation with Syria right now is just juicing those prices prematurely.
All right. John Kilduff, thank you very much for joining us. Jeff Kleintop, thank you as well.
Thanks.
Meantime, the market was also watching the Federal Reserve closely because Federal Reserve officials plan to continue hiking interest rates. According to the minutes of the last meeting, there's a chance that those increases could come at a slightly steeper pace, since the central bank views the economy as strengthening and inflation as firming. Ilan Mui has more from Washington.
A debate within the Fed over whether officials will need to change their language, showing the central bank moving from an accommodative monetary policy stance to one that is neutral or perhaps even restraining economic growth. The Fed minutes show that some participants argued the Fed will soon have to change its statement sometime in the future. It didn't say when, but in light of stronger economic growth and more solid inflation data. Several suggest that the Fed might also have to set the Fed funds rate above the long-run estimate, at least for a little while. But all participants agree that the outlook for the economy is strengthening and that it is more likely that the Fed will hit its 2% inflation target. A few participants even brought up the idea of modestly overshooting that goal in order to anchor inflation expectations. And this idea of the Fed switching gears came amid a robust debate over the impact of fiscal policy. Fed officials agreed that the tax cuts and spending deal are likely to boost economic growth, but they said that it's unusual for the economy to receive such a big fiscal stimulus at a time when it's already operating either at or near its potential. And some officials worried that bigger deficits could pose a downside risk to the economy. Another downside risk is tariffs. Fed officials said they're hearing from businesses in their districts that they're worried about the impact of these tariffs. Now, the tariffs alone aren't likely to hurt the economy, but a strong majority of Fed officials said that the possibility of trade retaliation and general uncertainty over the policy could wind up being damaging. Overall, however, Fed officials appeared bullish on the economy, and talk of tightening is at least on the table. For Nightly Business Report, I'm Ilan Mui in Washington.
The latest report on consumer prices supports the idea that inflation is firming. Prices compared to a year ago are up nearly 2.5%. That is the largest annual gain in a year, and it comes despite a monthly decline in the Consumer Price Index. According to the Labor Department, the CPI last month slipped 0.1%, its first decline in 10 months. The head of the International Monetary Fund is urging policymakers to avoid protectionism. In a speech delivered ahead of that organization's spring meeting, Christine Lagarde said trade restrictions hurt everyone.
Remember the multilateral system that transformed our world over the past generation. It has created millions of new jobs with higher wages. But that system of open trade based on rules and shared responsibility is now in danger of being torn apart. And this would, in our view, be an inexcusable collective policy failure.
Lagarde did not mention the U.S. and China by name. Well, trade, geopolitics, rate hikes, those are just some of the stresses being placed on this market, resulting in severe volatility. And now some investors are wondering if more choppiness is needed for the bull market to continue. Mike Santoli takes a look.
At a quick glance, it might seem the markets haven't done much since stocks began to struggle 9 weeks ago. The S&P 500 index today sits at almost exactly the same level it did on February 5th. The 10-year Treasury yield and value of the U.S. dollar are both likewise nearly unchanged from that time. Yet stocks have been extremely jumpy, even as they've made no net progress, as swirling hard-to-read issues on trade, tech regulation, and the special prosecutor's investigation provide constant noise. The S&P 500 has gained or lost at least 1% on 9 of the past 13 trading days, an unusual cluster of big moves. The choppy action has imparted plenty of pain to the average stock. With the S&P 500 about 8% below its January record high, more than a fifth of the stocks within the index have dropped at least 20%, and 2/3 are off more than 10% from their high. The severe volatility has also frayed investors' nerves. Even though the broad market indexes are right where they were 9 weeks ago, surveys of investor opinion show steep decline since then in bullish sentiment among individuals and professionals alike. Such steep discounts on individual stocks and more subdued investor optimism can be positives in forming a possible base for the market, assuming the underlying fundamentals haven't changed much. This seems to be the case at the moment. Corporate earnings forecasts have continued to climb since the start of the year, which has made stocks in aggregate look quite a bit less expensive than they were in late January. This is an interesting setup as earnings season gets rolling in coming days. Stocks trading well under their recent highs, just ahead of a reporting period where profits are seen rising more than 15%. The next few weeks will be a crucial test of whether a market that's been feeling plenty of pain can turn good fundamental news into gain for investors. For Nightly Business Report, I'm Mike Santoli.
It is time to take a look at some of today's upgrades and downgrades. Wall Street's biggest bear on Mattel is raising his rating on the stock to hold from underperform. The analyst at Jefferies says many of the risks facing Mattel are now baked into the toy stock's share price. The price target remains at $13. The stock rose 6.5% to $14.41. The iPhone supplier Synaptics saw its rating raised to buy from hold at Mizuho. The analyst there says a lot more of Apple's new iPhones will use the older LCD display technology. LCD models contain Synaptics chips. The price target was raised to $55. The shares gained 8% to $47.68. AeroVironment, which is a maker of unmanned aerial vehicles, was upgraded to buy from hold over at Stifel. The analyst cites strong revenue growth in its core business. The price target is now $65. That's the highest on Wall Street. The shares were up 17% to $54.28. Still ahead, investment advisory fees. They are changing, and it could hit your wallet. Facebook CEO Mark Zuckerberg testified on Capitol Hill for a second day, and it appeared as if today's session was a bit more difficult than yesterday's. Julia Borston is covering the story for us tonight.
Mark Zuckerberg fielding questions from 55 members of the House Committee on Energy and Commerce over a 5-hour hearing that was far more contentious than his appearance yesterday, with today a number of House members interrupting him and demanding yes or no answers. Like this exchange with Congressman Loebsack that captures a number of committee members' concerns about Facebook's data policies.
Is it possible for Facebook to exist without collecting and selling our data? Is it possible to exist?
Congressman, we don't sell people's data. So I think that that's an important thing to clarify up front. And then in terms of collecting data, I mean, the whole purpose of the service is that you can share the things that you want with the people around you, right, and your friends.
Questions weren't just limited to issues of data and privacy, with a number of committee members pressing Zuckerberg on concerns about content censorship, fake news, as well as the illegal sale of opioids on the platform. Zuckerberg saying better artificial intelligence is key to solving these issues.
When are you going to take down these posts that are done with illegal digital pharmacies? When are you going to take them down?
Congressman, right now, when people report the posts to us, we will take them down and have people review.
Why do they have to, if you've got all these 20,000 people, you know that they're up there. Where is your requirement? Where is your accountability to allow this to be occurring, this ravaging this country?
Congressman, I agree that this is a terrible issue, and respectfully, when there are tens of billions or 100 billion pieces of content that are shared every day, even 20,000 people reviewing it can't look at everything. What we need to do is build more AI tools.
Investors seem satisfied with Zuckerberg's responses based on the stock's move, up nearly 1% today after gaining 4.5% yesterday. For Nightly Business Report, I'm Julia Borston, Washington.
A Dow component hikes its dividend. That's where we begin tonight's market focus. Procter & Gamble is raising its quarterly dividend by 4% to almost 72 cents a share. It is the 62nd consecutive year the consumer products giant has increased its payout to shareholders. The shares were off 10 cents to finish the day at 78.27. Carnival Cruise Line also increased its dividend by 11% to 50 cents a share. In addition, the company said it was launching a $1 billion share buyback program. Shares of Carnival rose nearly 1% to 63.64. JetBlue reported improved operating metrics for the month of March. The airline also forecast an upbeat first quarter, saying a key measure of revenue would rise more than previously expected. Shares fell fractionally to $19.33. And after the bell, Bed Bath & Beyond reported a smaller than expected drop in same-store sales. The home goods retailer also delivered an earnings beat and increased its dividend to 16 cents a share. Those results, though, were overshadowed by the company's weak 2018 earnings guidance. Shares initially fell in after hours, but they finished the regular day up more than 1% to $21.50. Well, Fidelity is overhauling the way that it charges you for financial advice. According to the Wall Street Journal, the company is simplifying its fee structure, but that could result in some people paying more and others paying less. We're joined now by the Wall Street Journal's Sarah Krause, who authored that article. Good to see you again, Sarah. Welcome back.
Nice to see you. Thank you for having me.
So Fidelity joins a number of big Wall Street firms and small Wall Street firms, for that matter, that are really trying to kind of rejigger their fee structure. Why are they doing that?
That's right. So a number of firms, large and small, have made changes to their wealth management fee structure, partly in light of the DOL's fiduciary rule. So this was a rule that was crafted by the Obama administration and came into effect last April. The Trump administration has challenged it. It may be repealed in the end, but it's already triggered a number of fee changes across the industry. That rule was targeted at retirement accounts and required brokers to act in their clients' best interest rather than their own. But the impact of that rule has prompted broader changes across Wall Street, and actually the SEC has said that it may explore a similar rule across all types of accounts, not just retirement accounts.
So how, in Fidelity's case, does the fee structure change for people? I assume it kind of depends on how much money they have with Fidelity under management.
That's right. It's pretty much across the board. So new customers will not pay more. They'll be granted waivers that keep their pricing either at the same, or if the new fee structure results in a lower cost, they'll receive that lower cost. But for new customers coming in the door, it sort of depends on, it will be based solely on their assets under management, whereas before it depended on their assets under management, their investing style preference, their tax needs. So where there were a lot of variables before, now we're shifting sort of from an a la carte menu to more of a fixed price type pricing structure.
Does it matter what type of investments you have Fidelity deploying your cash into?
No, this won't at this point. So that's one of the things that the new fee structure sort of simplifies. So where previously it did matter if you were holding all Fidelity funds or a mixture of index funds and actively managed funds, now, regardless of what you're investing in, you come in the door, you have a conversation about your sort of needs, your long-term goals, et cetera, and a wealth manager sort of puts you in the funds that they deem appropriate for you.
All right. Sarah, thank you so much.
Thanks for having me.
Sarah Krause with the Wall Street Journal. Hate to tell you, but it's tax time, and that means hackers are out in force, and they have a new target. We'll tell you about it. Well, the deadline to file your taxes is quickly approaching. You have until April 17th to submit that return. And if you've been procrastinating, that would be me, we have some last-minute tips that could help you avoid costly mistakes. We're joined by Sharon Epperson. It's always good to see you. Both you and I are always working, and so we're always the last ones to file our taxes.
I know, we
right?
are, but we can still tell people what they can do.
Absolutely. So what are some of the biggest mistakes that people make if they procrastinate? What are they missing?
Well, one of the reasons why people procrastinate, I think, is because they're kind of afraid. It's a scary time for a lot of people. And one of the biggest tax day fears, according to a new survey by Wallet Hub, is making a math mistake on your return. 30% of people say that's their biggest fear come tax day. And it's actually one of the most common problems, making an error in calculations. But there are others, from putting in a misspelled name to a wrong social security number, or even the wrong filing status. So there are a lot of mistakes that people are making out there.
I also see from your graphic there that a lot of people may owe, but they can't afford to pay. And that's a big issue. What is their recourse?
Well, the recourse is you have to understand that you can file for an extension if you cannot prepare your return in time, but that is not an extension to pay. And that every moment that you wait, you are going to likely suffer a penalty or perhaps have to pay something in terms of interest for your debt. So that's important to keep in mind. The other thing to keep in mind is that you can set up a payment agreement with the IRS. Contact them, try to negotiate something. If you can pay it within 120 days, you can set up a payment agreement. If you think it's a bigger sum, it's going to take more than 120 days, look into an installment plan. And as a last resort, you know I hate credit card debt.
You
but
do.
I do hate credit card debt, but you could put it on the credit
IRS
card.
You hate more, right?
Right. So you want to pay that bill and you use your credit card, but know that fees will apply, and it could be 2% or more of the balance due.
You know, if you're waiting till the last minute, sometimes you may not have the time, or you may not know where to look for some things that really could put you at an advantage rather than the disadvantage.
Exactly.
What should they look for?
Well, keep in mind, you kind of do get a do-over. You can do an amended return, and you have until 3 years after the tax filing deadline, the original one, to file that amended return. What you have to keep in mind, though, it's not another 1040 that you're submitting. It's called a 1040X, and you have to mail in that return, a paper return. You can't e-file an amended return. So keep that in mind. Make sure you go to the irs.gov to find out where to mail that exactly. And know this, too, your 2014 return, if you find something there that you should have changed or done something so you could get that tax break, you only have until April 17th to get that one in. So you still have time, though. So
okay, now I'm
time
under
to
pressure again. But thank you, Sharon.
My
As
pleasure.
always, we really appreciate it.
Sure.
Sharon Epperson. Well, speaking of the IRS, it has been working to make it more difficult for cyber criminals to file fraudulent tax returns. But the criminals have upped their game. Instead of just stealing your personal data, they're now targeting tax professionals. Andrea Day has more on this new form of tax fraud.
Here we have an individual who is looking for tax IDs.
This is the dark web, where cyber criminals go to buy and sell loads of stolen data.
Here we have another individual who's selling tax IDs.
One of the hottest tickets right now, your tax pro's ID number, used to file returns online. Cybersecurity firm Flashpoint's Roman Sanikov.
The tax prep professionals are really the new vector of attack.
He says the ID numbers are a virtual crime kit for thieves, where they can file fake returns by the thousands.
How easy is it for the criminals to get this information?
It's quite easy. There are thousands, probably hundreds of thousands of services that are selling this information on the deep and dark web.
And using that trusted pro number could make the return seem legit to the IRS. That, according to IBM Securities' Caleb Barlow.
Oh, well, it's an IP address that we've seen before. It's a signature of a computer we've seen before. We know that's a tax professional, so they're going to be submitting lots of returns.
At IBM Security, they've been watching closely as these new attacks unfold.
And remember, this is a $445 billion annual industry of organized crime, and tax fraud is one of the primary areas they focus.
So how do they steal pro IDs in the first place? According to experts, usually by sending malicious email links and attachments that someone clicks on by mistake.
Once we've clicked on it, the thief is inside.
Larry Gray is a CPA and with the National Association of Tax Pros, or NATP.
It's kind of like breaking into the bank. It's a gold mine.
And he says with new tax laws in place, his fellow CPAs are searching for info and could be more likely to open an attachment.
This perfect storm is created by a more sophisticated adversary and an environment where we have lots of confusion and lots of questions.
What does that spell for tax season 2018?
I think it's going to be some chaos.
And the tax pro?
They may have absolutely no idea that their computer has been compromised and a criminal is actively harvesting that information.
The IRS now warning accountants.
We had about 75 tax professionals report that they had been victims of some sort of a taxpayer breach. So that, unfortunately, is a 60% increase for the same period of time last year.
And experts say the best tip for pros is to educate everyone in the firm to never, ever open an attachment they didn't request. And for the rest of us U.S. taxpayers, only use someone you trust and ask them how they store and protect your data. Because once the pro's computer is compromised, your private info is also at risk. For Nightly Business Report, I'm Andrea Day.
Before we go this evening, here's another look at the day on Wall Street. The Dow fell 218 points. The Nasdaq was off 25, and the S&P 500 declined by 14. And on that note, that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks so much for joining us. Have a great evening, everybody, and we will see you right back here tomorrow.